Here's everything you need to know about the Vancouver real estate market in March 2025. We're going to talk about the impact of tariffs. We're also going to talk about the rental report and the general market conditions. First, let's talk about the total number of sales. According to the latest statistics, we saw a total number of 1,827 transactions in February 2025, which is about 11.7% less than what we saw in February 2024. It is also about 29% below the 10-year seasonal average. This, in general, is not good news. If you remember, February 2024 was already a very slow month for real estate transactions. So having this number be almost 12% below that number, yeah, the market is very sleepy right now. And if we look at the total number of inventory on the market right now, the picture gets even worse, because we see a total number of 12,744 listings currently listed on MLS, which is an increase of 32.3% over February 2024. This number is also about 36.4% above the 10-year seasonal average. Now, this high number of total inventory is not new for February. We actually have experienced this number being well above the 10-year seasonal average for a while. We see more listings currently on the market and not enough sales clearing this inventory. And if we compare it to the 10-year seasonal average or to the year ago, we see more listings, more inventory on the market, and less sales, which tells us these are pretty favorable buyer conditions. Now, if you look at the number of new listings, so we just talked about all the listings available on the market, but let's just look at the brand new listings for February 2025. We saw a total number of 5,057 properties being listed. That number is about 11% above what we saw in February 2024. It is also about 11.6% above the 10-year seasonal average. So here is a bit of hope, a bit of good news. Even though the total number of sales is down, and the total number of listings is well above the 10-year seasonal average, at least we didn't see a huge rush of new listings to the market. Yes, it is still above the 10-year seasonal average, but it's not drastically above the 10-year seasonal average. 11.6% is okay, especially with this tariff war threat. From my experience, what I see on the market right now, there is a lot of wait and see tactics going on. There are buyers in the market. A lot of the listings are getting views. However, very few people are actually purchasing. A lot of people are just waiting to see what happens with these tariffs, if the tariffs actually take place or not. As I'm recording this video, some of the tariffs have been rolled back. Some of the tariffs are still in place. And of course, this creates a lot of uncertainty for Canadian economy, for people's job security. And that's why a lot of buyers are still on the waiting lines. At the same time, a lot of sellers that need to sell, especially when they have a vacant unit, well, they have no choice but to really be aggressive with their marketing, with their pricing, and that creates some pretty good opportunities, but for those brave enough to take advantage of them, because of course, at the moment, the future of Canadian economy and just the job security in general is a bit uncertain. However, there is a bit of a silver lining in this whole story. The fact that Bank of Canada right now looks like is strongly considering another interest rate cut. About a month ago, it seemed like that was very unlikely. It seemed like the Bank of Canada would just hold the interest rates as they currently are. But now it looks more likely that next week, mid of March, we will see another interest rate reduction, probably another 25 basis points, which should probably stimulate the market, especially if the tariff threat goes away. It would also make qualifying for mortgage and the overall mortgage payments a bit more affordable. And one of the reasons why the Bank of Canada was looking to hold the interest rates as they are is because this month, March, is sort of the beginning of the official spring market. Usually spring market is tend to be a lot more busy. We see more transactions, we see more buyers, more sellers entering the market. And I think from Bank of Canada's perspective, they didn't want to add more fuel to the fire. They just wanted to see what would happen with the market if they didn't intervene. As it looks right now, the market is still very sleepy, and that's largely due to the tariffs. I keep on repeating the same thing. But at the same time, it's very hard to predict what would actually happen if the tariff threat goes away and the interest rates get reduced. maybe we will see a spike of new buyers entering the market. The good news for the buyers, I guess, is the fact that there is still a lot of inventory on the market that still needs to be cleared. So it doesn't look like the prices will be jumping like what we've seen in the previous years. It looks like it's probably going to be a gradual increase if there is an increase, of course. Now, that is also supported by the sales to active listings ratio number. So that number for the detached houses is about 10.7%. For attached properties, it's 18.5%. And for apartments, it's about 16.8%. As you can see, pretty much all segments of the market are fairly slow. Looks like duplexes as well as townhomes are doing still fairly well. And usually this segment of the market is pretty resilient because if you have a family of 2 kids, you're probably looking at something with 3 bedrooms or maybe 4 bedrooms. And if you can't afford a house, or if you're not willing to buy the house, a 3-bedroom townhouse, a 4-bedroom townhouse is probably your next best bet. And for that reason, townhouses, historically speaking, are a little bit more resilient to the market fluctuations because they're not investor-driven properties, they're more family-oriented properties, and they're the last sort of property before the big jump in price when you have to step up to the detached housing property. In terms of the real estate prices, they pretty much stayed flat as they have been for a while now. So for the detached housing market, the prices have increased by almost 2% in the last year, and they are unchanged since January 2025. For the apartments, the prices have decreased by about 2.8%, and they have decreased about 0.1% in the last month, although I wouldn't pay attention to that number too much. Yes, the prices in general are down. However, it really depends on what type of apartment, what area, and what type of the building. And lastly, the prices for attached homes, they're about 1.2% lower than February 2024 year-to-year change, as well as 1.7% lower than January 2025. And again, from my experience, they stayed about flat. And lastly, let's take a look at the real estate rental report. Vancouver still remains the most expensive city in Canada for rent. However, the prices have been going down year over year. They're about 6% lower for 1-bedroom apartment and about 4.6% lower for a 2-bedroom apartment. And it is a similar story for Burnaby, Coquitlam, Richmond, etc. So overall, the prices are still coming down. However, the rate of reduction has slowed down quite a bit. I don't see these ginormous drops in terms of rental prices. They're more steady, more flat, but still on that downward trend. And that's it for this video. I hope you enjoyed it. If you did, please give it a thumbs up, subscribe to the YouTube channel for more videos like this in the future. And if you're looking for real estate here in Greater Vancouver, you just don't know where to start, I have an absolutely free buyer's guide. The link to that will be in the description below. It's absolutely free. You don't need to sign up for anything. It's just a tool to help you get started and to understand how the process of buying works. Thanks for watching, and we'll see you next time.